and welcome to today's fast and packed video, which is called S&P 500 is breaking. Let's examine together whether it's breaking out or breaking down, and generally which way the market wind is blowing, if I can paraphrase. I will be linking to yesterday's video where I had been diving into the nuances of what is driving this tariff brinkmanship and how to recognize upcoming periods of lull. So you want to review that video in full. Here is the 4-hour chart of S&P 500. Is anyone disappointed that we did not get above the highs of 90-day tariff relief? We shouldn't be. No one should be, actually, following Thursday's inside candle, daily chart inside candle, which had, however, clearly shown that buyers are stronger there. Prices have not broken out just yet. Does it mean that they will get rejected? If one examines the tariff news flow, it's now kind of in China's backyard to do one or two somewhat kind things towards the States, taking down the heat. However, markets have already begun discounting that, and given what is the policy stance, how it is developing, for instance, in the direction of the Ukraine conflict, one can never underestimate the escalation potential, however positive the charts look at the moment. And that's exactly what I'm doing with clients, whether they are swing or intraday. They are up to date to the latest moves and what I expect based on the headlines to unfold. The hourly chart shows waning upside momentum. However, the indicators look is more positive, so it's the question and matter at hand is somewhat more complicated than would be the breakdown below yesterday's lows, meaning reverting back below the Sunday's bullish gap, or not. For now, prices are meandering there, and Tech had been having a great Monday, so that's reflected as well in yields, which have been the key precondition on both the long and short ends. That as well is tying to some kind of a dollar stabilization, which is very much a work in progress. So yields and dollar is what I would be watching most intraday. The bond market chart. Which way does it lean when it comes to risk taking? Have we seen a rejection and junk corporate bonds after the latest stabilization in credit spreads? Are these going to pose a problem? Clearly, this chart is leaning one way. Volatility. We are progressing in the triangle in the making. Thus far, we have not yet seen the breakdown below, neither a breakout above. The base is over time getting elevated as those rising various moving averages attest to, and that means that for now we are kind of in no man's land, but it makes sense to be positioned for a certain outcome, even if that would not be on the level of fireworks Wednesday or fireworks following the initial Sunday announcement, or the Lutnik Denver Sunday. So Stay tuned for what is going to be coming in the markets, and it will be bonds and US dollar first, reflecting that aka the great pacifier, which had been the subject of yesterday's video, to which I will be linking once again as much as to the weekend one. I joined page for help you select what's right for you based on what and how you trade. You know my journey pretty well. Obligatory disclaimer, and talk soon.